You have probably spent most of your career doing what you were told would lead to a good retirement. You earned a strong income, saved into your 401k, and tried to avoid making major financial mistakes. Along the way, you may have also built up company stock, RSUs, a brokerage account, old retirement plan, and other benefits through working. Then you reach your late 40s or early 50s and realize the questions have changed. You're no longer asking whether you should save for retirement. You've already been doing that for many years. Now you want to know whether everything you've built is actually enough to take a step back from your corporate job. You may also be wondering how you would pay for health insurance before Medicare, whether taxes will take more of your retirement income than expected, and how a collection of investment accounts eventually turns into money deposited into your checking account each month. That is where New Horizons comes in. We work with successful executives, directors, vice presidents, and other professionals throughout the Twin Cities, the surrounding Minnesota Metro, and western Wisconsin. Most have been saving around 15% or more of their income for many years. They are not coming to us because they forgot to prepare. They are coming to us because the closer retirement gets, the harder it becomes to see how all the pieces fit together. Our job is to help make sure that picture is clear. The process begins with a discovery call. Most people do not come into that meeting with one perfectly worded question. They usually say something more like, I think we've done a pretty good job saving, but I have no idea when I can actually stop working. Or, I enjoy my job, but I want to understand when I can retire if my role becomes less enjoyable or my life goals change a few years from now. So we spend some time understanding what being ready would actually mean and what retirement looks like for you. Is it playing golf with your friends, taking vacations with your spouse, or spending time with your kids or grandkids? For one person, that may mean retiring at 55. For another, it may mean cutting back, taking a lower paying role, or reaching the point where a company buyout or a difficult new boss no longer controls that decision. That is really what the first conversation is about. We're trying to understand the life you want your money to support before we start talking about what needs to change. Of course, we will still need to understand what you've built. We'll talk about your income, spending, retirement, company benefits, investments, and anything else that may affect the plan. But the meeting should not feel like we are reading questions from a form. It should feel like a real conversation about where you are today, what may change over the next several years, and how to turn your savings into that next stage in life. By the end of that call, we should understand the question you're trying to answer. You should also have a clear sense of how we work and whether continuing the process truly makes sense.
After the discovery call, we begin putting the pieces together. Most people have a general idea of what they own. They know roughly what is in the 401k, what their company stock is worth, and what they have sitting in savings or a brokerage. What they usually have not seen is how those pieces work together after your paycheck stops. That is what Plan 1.0 is designed to show. We take what we have learned in the first meeting and build an early picture of where things stand today. Then we begin testing when work may become optional and where the income could come from if you decided to leave. That is often where the real issue becomes clear. Someone may have saved several $1,000,000 but still have very little they can comfortably use between the age of 55 and the point when they plan to rely on retirement accounts. On paper, they look wealthy. In real life, the first few years after leaving work may still be difficult to fund. Another person may discover that too much of their financial life depends on one company. That same employer may provide the salary, bonus, health insurance, stock, and a large part of the investment portfolio. That can feel perfectly manageable while the company is doing well. It feels very different after an acquisition, a leadership change, or a sharp drop in the stock price. For someone else, the biggest unknown is healthcare. The normal spending works, the mortgage is under control, and the investments appear strong, but the 8 to 10 years before Medicare kicks in has never been fully added to the plan. Plan 1.0 helps us see those gaps. It gives us enough information to explain what appears to be working, what may be standing in the way, and which decisions deserve a much closer look. It is not the finished plan. It is the point where the conversation begins to feel less like guessing and more like planning.
Once Plan 1.0 is ready, we meet again and walk through what we found. The goal is not to bury you in charts or spend an hour proving how complicated financial planning can be. The goal is to make the choices easier to understand. Suppose the first version shows that retiring at 55 would put a lot of pressure on the plan, while retiring at 58 looks much better. We do not want to stop there and simply tell you to work 3 more years. We want you to understand what those 3 years are actually accomplishing. It may be 3 more years of saving. It may be enough time to pay off the mortgage, allow another stock grant to vest, build money outside the 401k, or shorten the number of years you need to pay for health insurance on your own. Once we know what is creating the difference, we can begin talking about whether there is another lever that can be used to solve it. This is also where real life starts entering the plan. A company may have just been sold, a severance package may be possible, deferred compensation may begin paying sooner than expected, and one spouse may want to keep working while the other is ready to leave. We can begin showing how those decisions affect the larger picture. By the end of this meeting, you should understand where you appear to stand today and which part of the plan still need deeper work. Some people may decide that the early analysis gave them enough direction to continue on their own. Others may decide that they want help finishing that plan, making the changes, and putting the changes into action. For those clients, the next step is our financial independence transition.
The financial independence transition is our 30 to 60 day onboarding process. This is where we move from a high-level view into the details that will determine whether the plan can actually work. The name we chose is intentional. You have already spent years building wealth. Now the work is about preparing that wealth to replace your paycheck to ensure you can enjoy that next stage in life. We begin by looking more closely at what life will cost after work ends. That is not as simple as taking your current spending and carrying it forward forever. Some expenses may disappear, others may increase. You may stop saving 15% of your income, but travel may become a larger part of your life. The mortgage may end a few years after retirement, while healthcare may become much more expensive for a short period of time. Once we understand that, we can look at whether the money is being saved in the right places. Earlier in your career, putting as much as possible in the 401k may have been the obvious move. 5 years before an early retirement, that answer may change. You may still want the employer match and the tax benefit, but you may also need to build more money that can be reached without waiting for the unusual retirement account rules. That may mean placing more into cash or a brokerage account. It may mean using an employee stock purchase plan differently or paying down a debt that would otherwise follow you into retirement. The issue is not simply how much you are saving. It is whether each new dollar is helping you solve the problem that stands between you and leaving work. Healthcare is often the part of early retirement that feels the least clear.
Planning for healthcare. Healthcare is often the part of early retirement that feels the least clear. Most people understand their mortgage and normal household spending. They can see those numbers every month. Health insurance before Medicare is different. The price may depend on your age, where you live, the type of coverage you use, and even how income appears on your tax return. That means healthcare cannot be planned on its own. Suppose you leave work at 57 and plan to buy insurance through the public marketplace. Taking a large amount from a retirement account or realizing a major gain from a company stock may increase your income for that year. That could also change what you pay for medical cover. This is why the tax plan, healthcare plan, and retirement income plan need to be built together. Our goal is not simply to tell you that health insurance will be expensive. You probably already know that. The goal is to instead show how it may be paid for, what choices may affect the cost, and how those years fit into the larger retirement plan.
Next is looking at taxes before the decision is made. Taxes become more complicated for executives because income often arrives from several different places. A person may retire and assume the tax bill will immediately fall, then the final year includes salary, bonus, severance, vested stock, and maybe even a deferred compensation payment. That may end up being one of the highest income years of the entire plan. The years after that may look very different. Once your paycheck, stock compensation slow down, there may be more room to make choices. That could affect when company stock is sold, when retirement accounts are used, or whether moving money into a Roth makes sense. We are not looking for a trick that makes taxes disappear. We are trying to keep major tax decisions from happening by accident. We also help organize what should be reviewed with your CPA. With your permission, we can speak directly with that CPA, so you are not responsible for carrying the detail between two different professionals.
Turning investments into a paycheck. For most of your career, money has moved in one direction. Your employer pays you, you pay the bills, and part of what remains goes into investments. Retirement reverses that flow. Now the investments need to begin paying you. That can feel strange, even for someone who has spent years building wealth. You may have a 401k, a brokerage account, company stock, cash, a pension, and Social Security arriving at different times. The question then becomes which source should be used first and how the money should reach your bank account. We help create a system for that. You may keep enough cash available for near-term spending, while another part of your portfolio stays invested for later years. A regular transfer can then move into checking each month, much like the paycheck you were used to receiving before. The exact setup will be different for each person. What matters is that retirement income should not feel like a series of random withdrawals. You should not have to decide which investment to sell every time a major bill comes due. There should be a clear plan for how the money reaches you.
Making sure the investments fit the plan. A person can own good investments and still have the money in the wrong place. The investment itself may not be the problem. The problem may be that the money will be needed sooner than the investment was built for. Money intended to support the first few years of retirement should not always be handled the same way as money that may not be touched for another 20 years. Company stock also needs special attention. When the same company provides your paycheck, bonus, insurance, and stock awards, holding a large amount of its shares can create more risk than the account balance alone suggests. That does not mean every single share must be sold at once. It means the company's stock should be viewed as part of the entire financial picture, rather than as a separate account that is never questioned. The goal is not to move money simply to create activity. It is to make sure each part of the portfolio has a clear job and supports the life the plan is meant to fund.
Protecting the plan. We also review the areas people tend to put off. That includes insurance, beneficiary forms, and estate documents. Most people are not excited to spend a meeting talking about these topics, but a missing or outdated detail can cause problems for everything else. An old life insurance policy may no longer fit. A retirement account may still name the wrong person as beneficiary. A will may have been signed years ago, before the family or financial situation change. We help review what is already in place and decide whether anything needs attention. Sometimes the next step is simple. Other times, an estate planning attorney should be involved. We do not write legal documents, but we can help organize the questions and coordinate with the attorneys when needed.
Comparing the current path with the new plan. Once the major planning work is complete, we update the financial independence analysis. This is where we compare the path you were already on with a path that reflects the recommended changes. The difference may come from saving into another type of account, reducing company stock over time, paying off your debt, or changing how healthcare is funded, or even creating a clearer order for retirement income. This helps you see which decisions are actually moving the plan. The numbers are not estimates, they are not promises that the retirement will happen on an exact date, but they give you a better way to compare your choices. Instead of staring at the total account balance and wondering whether it is enough, you can begin seeing what gives you more flexibility and what may be holding you back.
Putting the plan into action. A good plan should change what happens next. Once the recommendations are clear, we help organize the work. Some changes may happen right away, others may need to unfold over several years. After the first planning work is complete, we hold what we call a State of the Union meeting. We review what has been finished, what remains incomplete, how the changes affect the plan, and what deserves attention next. From there, the conversations continue as life changes. A new stock grant, company buyout, job offer, family need, or early retirement date can all change the next decision. The plan should not stay frozen while the rest of your life continues to keep moving.
Most of the people who come to New Horizons have already done the hard part. They built successful careers, earned strong incomes, and saved for the future. What they need now is not another reminder to save more. They need to understand whether what they have built is ready to support the next stage of life. Our process is designed to help answer when work may become optional, how healthcare and taxes fit into that decision, how investments become income, and whether the money is positioned correctly for the years ahead. It begins with a discovery call, and from there, we build Plan 1.0 and walk through what we find. For clients who want help continuing, we complete the financial independence transition and help put the decisions into action. The goal is not simply to reach a retirement number. The goal is to reach the point where staying at work is a choice. You can schedule a discovery call in the link below in the description. If you have enjoyed this video, please click subscribe for future videos from New Horizons Boutique Financial Services.